Okay, good morning. What we're going to be doing today is we are going to finish most of Chapter 13. Not all of it, but we will finish the homework for Chapter 13 today. And we have lots of questions today. And then on Wednesday, we'll finish up some questions for Chapter 13, and I'll talk about the final. So on Wednesday, we'll be talking about the final. Just in case you're interested, I did put the final review sheet up on Blackboard, so that's available for you there. Okay, Chapter 13 has 6 learning objectives, but they're very, very small. A lot of them are interconnected, so I think we'll be fine. This is not a hard chapter. This chapter, the big learning objective are the ratios and the ratio formulas. We'll go through some of those today, but they go pretty quickly. Also, the homework. I do want to point this out. Whoever's mouse pointer that is. Okay. Okay, we're only going over exercise 1321 in class today. All the other ones, when you're doing the homework, remember they are in the video lectures. So exercise 1321 is the one we saved for class. The other ones are in the video lectures, so that's where you'll find those. Okay, so we're going to start with a series of questions, so a whole bunch of true-false questions, very similar to each other, kind of teasing out the difference between vertical analysis, horizontal analysis, and this all relates to the video lectures on Chapter 13. So the first one, vertical analysis highlights changes in financial statement balances from period to period. True or false? So we're talking about vertical analysis. Okay, so what do you think, true or false? Okay, vertical analysis, when we're doing vertical analysis, we're comparing everything within the same year. So false, yes. Okay, so this one is going to be false, and the reason it's false is because vertical analysis, we're comparing everything in the same column. If we think about vertical, going from top to bottom, we're analyzing everything in that column. So vertical analysis analyzes things within a given year, not period to period. Okay, now horizontal analysis. Horizontal analysis compares financial statements in the current period with other items in the current period. Is that true or false? False. False. Yes. Okay, horizontal analysis compares financial statements in the current period with other items in the current period. She said false, and that is false. What it's describing there is current period items with other items in the current period. That's vertical analysis. So these first two were false. Good. Good. Lots of falses online. Good. Okay. So being able to pick out the difference between a vertical analysis and horizontal analysis is important. And I think I have several more, so they'll go pretty quickly then. Okay, now the percentage change in financial statement balances is computed by dividing the dollar amount of the most recent period by the base period dollar amount. True or false? False. Okay, and that is false, you're right. The reason it's false is because you want to divide the change by the base period amount, not the current period amount. So take your change between the two periods, divide by the base period amount, and that'll give you the percentage change. Half and half? Yeah, okay. So online we had about an even divide on that. So it is false. You want to divide the change by the base period amount. Okay. Now when we're talking about horizontal analysis, in horizontal analysis we're comparing period to period. Do we do that only on the income statement, only on the balance sheet, only the statement of retained earnings, or all three statements? Pardon me? Is it all three? Mm-hmm. Yes. Okay, she answered D, all three, and that is correct. Okay, so you can do horizontal analysis on the income statement, the balance sheet. You're looking at changes from over time on the income statement, on the balance sheet, on the statement of retained earnings. So horizontal analysis performed on all three statements. This statement that's missing here, statement of cash flows, typically you don't do horizontal analysis on it. That's why it's not listed. So there's four main statements, but okay. Now, when comparing companies of different sizes, vertical analysis. Vertical analysis is comparing the different items within the same period would be a useful tool. True or false? I'm going with true. Let me explain why. Okay. Well, maybe not. Sometimes not. Vertical analysis, when we think about what vertical analysis is, let's just think about the income statement. Vertical analysis says, company A, we're going to figure out what percentage each item on the income statement is of total sales. So we would know, for example, cost of goods sold could be 52% of sales in company A. And then company B, we take their cost of goods sold divided by their revenues, and maybe we find their cost of goods sold 30%. So what that allows us to do is compare these companies of different sizes by saying, oh, your percentage expense is too high. And so this is, vertical analysis is useful to compare, because otherwise you have companies of different sizes. Who's to say your cost of goods sold is in line? A lot of times we use percentages to do that. So this is true. Vertical analysis is very useful for comparing companies of different sizes. Okay, so we're doing a vertical analysis. We say we're comparing everything in the column in a given year to using something as the base. What's that something on an income statement? So this statement, when performing vertical analysis of an income statement, net income is usually used as the base being that thing that we divide everything by. Is that true or false? What do you think? Okay, on this one, it's great day here. No, it's fine. Okay, so this is false. The thing that we divide everything everything by on an income statement is always going to be, virtually always, for our purposes, sales revenue, okay, not net income. As an aside here, we use sales revenue as the base on an income statement. Do you know what we use as the base on a balance sheet? Total assets. Yes, absolutely correct. So these are two things I would absolutely know. Income statement, sales revenue is your base. Balance sheet, total assets is your base. Okay, so again, looking at this vertical horizontal analysis, the relationship of each individual asset as a percentage of total assets is an example of vertical analysis. Okay. What do you think? Skylar.
Oh, sorry. I'm going to say true.
True. That is indeed correct. Okay, that's just another way of stating this. So there is not a standard language on this. It's not like there's generally accepted accounting principles where it's always going to be stated this way. But when you talk about analyzing a company, taking each asset as a percentage of total assets is an example of vertical analysis. I think we have just a couple more and then we're going to do the homework problem. Vertical analysis compares an item on a financial statement to the same item in a prior period, true or false? We should all get this at this point. False. True? Okay. False? True? What do you? True? What do you think? False? What do you think? False? False? What do you think? False. False. I'm getting into false territory. What do you think? False. 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 What do you think? What? False? Okay. Okay. So got down to a lot of falses, and this is indeed false. Okay. Vertical analysis is within the same period. Vertical analysis is we're on the income statement, we're dividing everything by net sales. On the balance sheet, we're dividing everything by total assets. Vertical analysis doesn't have anything to do with comparing to prior periods. Prior periods is horizontal analysis. So online, mostly false, so that's good. Okay, now exercise 13-21A. Okay, this is an exercise where we're going to do a lot of ratios. So the numbers are given in the table in the book, and this table is not, those are not complete financial statements. Those are excerpts, so not everything is on the balance sheet is in the table or on the income statement. Those are just selected numbers. So we have some numbers for 2012, 2011, and then a few selected for 2010. And we have to compute the various ratios. So we have to, and then we have to answer two other questions. So we will get to those. So first of all, what I'm going to do is I'm going to try to leave that table up at the top, put the formula for that ratio Okay, and these formulas I would have on my sheet because they're pretty easy to do if you know it, so write it on your sheet for the exam. So current ratio. Current ratio is current assets divided by current liabilities. That is the formula for the current ratio. This is one of the most common ratios. So current ratio is current assets divided by current liabilities. For 2012 then, our current assets are $245,000, our current liabilities $131,000, so that gives us 1.87. So I'm getting those numbers from the 2012 column above. Okay, so there are the 245 and the 131. So then for 2011, I'm going to take the total current assets from 2011, divide by the total current liabilities for 2011 and get 2.98. Now, one of the questions, question 2 I believe, asks us what happened if each ratio improved or declined. So I'm going to deal with that right here. So when we look at this, the current ratio is telling us what percentage, basically how much more our current assets are than our current liabilities. And in a perfect world, we would want, everything else being equal, we would want the current ratio to be as high as possible. So 2011 we had 2.98, which is really strong. Current ratio, you generally want to see it being above 1 for sure, 1.52, somewhere in that range. So in 2012 it's still okay, but it has declined. It's deteriorated. So a lot of times we don't look at just one number, we have to look at it in relationship to time. So 2011 it was 2.98, 2012 it's down to 1.87, so there is a little red flag raised because that one deteriorated. Okay? So when you're answering the question for the second part of this, the second question in this problem, it talks about each one of these. Did they improve or decline? This one declined or deteriorated. Okay, so then our next ratio is the quick ratio. The quick ratio is like the current ratio in that it's looking at our ability to pay our current liabilities, but this one's a little more stringent. It doesn't include inventory because it makes the assumption that inventory is hard to sell sometimes, so we don't want to include that as part of our resources. So quick ratio is our cash plus our short-term investments plus our net receivables divided by current liabilities. So when we apply that to 2012, we're going to have $53,000 as our cash, $17,000 in short-term investments, $77,000 net receivables. Divide that all by our current liabilities of $131,000, gives us 1.12 as our quick ratio. Okay, so that's what we have in 2012. Now, 2011, we're going to take those same numbers from the 2011 column and we get a quick ratio of 2.11. Okay, now to that question where it's saying what happened to this ratio, did it improve or deteriorate? This one, again, a quick ratio, all other things being equal, you'd like it higher. So in 2011, it was 2.11, which was actually a pretty high quick ratio. It fell to 1.12 in 2012, so that's a deterioration. It's still okay just looking at it by itself, but that's a pretty big decline, so that's some cause for alarm. Okay, so this one deteriorated, the quick ratio deteriorated. Okay, on to the next ratio, inventory turnover in days inventory outstanding. These are kind of a two-step process. So inventory turnover in days inventory outstanding. Okay, so we've got two formulas there. We have to compute two things. Inventory turnover is cost of goods sold divided by average inventory. And emphasis on average. And then days inventory outstanding, how many days does our inventory stay before we sell it on average? 365 divided by our inventory turnover. So that's why we have to do one before the other. Okay, on inventory turnover, cost of goods sold in 2012, we can see it's 276,000. So that's easy. Now below that, where it says average inventory says what was our average inventory for the year. If we look above, we see inventory for 2012 is 90,000. That's on the balance sheet. That is not an average figure. That's how much inventory we had on the very last day of 2012. So to get our average inventory, we take the 90,000 from 2012. We add the inventory that we would have had at the beginning, the first day of the year, which is the same as what we had at the end of 2011. So we take the 90,000 plus 72,000 divided by 2. So what we're going to see there is we're going to take 276,000 divide by the average inventory. Average inventory, 90,000 from 2012 plus 72,000, which is what we would have started 2012 with, divide by 2, gives us 3.41, and then we divide 365 by 3.41 to get 107 days. Okay, so that 107 days, what? Yes, the 72,000 is the end of 2011 inventory, which is the same as the beginning of 2012 inventory. What we end one year inventory with is what we start the next year with. So we're looking for average inventory. Average inventory is our beginning of the year plus our end of the year divided by 2. Another way, and most times we're given end of every year, so you just take end of this year plus end of last year divided by 2. And that will get you your average inventory in every case. So for 2011 average inventory, we'll take 2011 72,000 plus 2010 60,000 and divide by 2. So that's what we're doing to get our average inventory. Okay. So what we've got here, what we come down to, that 107 days, what that tells us is it's taking this company 107 days on average to sell an inventory item. That's what we've just calculated. They turn over their entire inventory. They sell their entire inventory 3.41 times per year. Okay, and that translates into, sometimes it's a little bit easier to understand it, to think about it, to say it takes 107 days to sell one item of inventory. What's a good inventory, days inventory outstanding? It depends totally on your industry. If you're a grocery store, if your days inventory outstanding is 107 days, you're in big trouble. Okay, a grocery store is going to have days inventory outstanding very, very low because the items are perishable. On the other hand, a jewelry store may have a really long days inventory outstanding, so it depends on the industry. This is 2012, so it doesn't really tell us anything other than it takes 107 days in 2012 to sell an inventory item. So let's do 2011 now. We're going to do the same calculation with 2011. So exact same calculation, we're just calculating, we're putting in the 2011 numbers. So what we end up with is we end up with 86 days as your days inventory outstanding for 2011. Okay, so 86 days. So 86 days in 2011 it took us to sell our average item of inventory. In 2012 it took us 107 days. So have we improved or declined since 2011? 2011, so last year it took us 86 days to sell a piece of inventory. Yeah. Okay, yeah, because we did them in reverse order. Okay, so 2011 it took 86 days 2012, it took 107 days, so we have deteriorated. That has declined, decreased. And that's a bad thing when we're talking about inventory turnover. You want to be able to sell your items as fast as possible. Do you want to be, in theory, you'd want to be able to sell an inventory item in a day. You know, so going from 86 days to 107 days, that's certainly some cause for alarm because that's a pretty big jump in 1 year. So their inventory is not selling as fast as it used to. So that's something to make note of. Okay, so now we're going to move on to the next ratio, accounts receivable turnover. And this is another one where we have to do two calculations. Actually, accounts receivable turnover is net sales divided by average net accounts receivable. And down at the bottom, I just told you how you calculate average receivable. Same thing. Take this year's receivable, last year's receivable, divide by 2. That's the formula for accounts receivable turnover. Yes. Okay, so for 2012, okay, our average net receivables, we're going to take our 77,000 from 2012. Add our 80,000 from 2011 divided by 2. So it's exactly how we were calculating the average for inventory before. Our top number, net sales, 494,000. So we get accounts receivable turnover 6.29. And when that 6.29, that's times. So when we talk about that, our accounts receivable turnover is 6.29 times in a year. That's how rapidly customers are paying us back. So then we do the same thing for 2011, and we get 7.43 times. Okay, now to look at, did that improve or decline? Accounts receivable turnover. You want your customers to pay you back as fast as possible. You want the cash in. All other things being equal, you want your accounts receivable turnover to be as high as possible. So high is better. So 7.43 times in 2011. Our customers paid us a lot slower in 2012. We only turned it over 6.29 times. So this one deteriorated as well. This one's telling us our customers did not pay us as fast as we would have liked, or as fast as they did in 2011. So this is another one that shows some deterioration. Okay, now another one that's very closely related to accounts receivable turnover is days sales outstanding. Okay, days sales outstanding, the formula is at the bottom there. Is your average net receivables divided by 1 day's sales. Okay, so 2012, our average net receivables, we would have calculated that on the prior page, 77,000 plus 80,000 divided by 2. So there's our average net receivables divided by 1 day's sales. Okay, 1 day's sales, I don't have it listed on here, but I know. I'm just going to forward ahead to see if I put it. There we go. Okay, there it is. 1 day's sales, that 1,353, 1 day's sales is your total sales for the year. So our total sales for the year, 494,000 divided by 365 days is 1,353. So on all one-day sales is, one-day sales is saying how much on average did you sell per day. So we have total sales for the year of 494,000 divided by 365 days. So that's where the 1,353 comes from. Okay, so back to our ratios. I guess that was a little out of order there. Okay, so 2012, our days sales outstanding, 58 days. And then in 2011, okay, there we go. Okay, so the same number in days sales outstanding in 2011 is 49 days. Okay, now in terms of did this improve or decline, in 2011, it took 49 days for a customer on average to pay us. In 2012, it took on average 58 days for a customer to pay us. So customers are paying us much slower, which is in line with what we saw with accounts receivable turnover. So this has deteriorated as well. It's taking longer for our customers to pay us, which is not a good thing. Okay, now looking at it from the standpoint of the bills that we pay, this is a two-step process calculating accounts payable turnover and then days payables outstanding. So I'll wait for a minute. There's the formulas. Okay, 2012. 2012, we will have accounts payable turnover of 4.6, and that will be 4.6 times, and then that translates into 79 days. Okay, so that was 2012. So let's go back one year to 2011. In 2011, we're going to do the same calculation and come up with 68 days. So I'll pause for a minute again. Okay, 2011, the bottom line is for accounts days payable outstanding, on average, how long does it take us to pay one of our bills? It was 68 days in 2011. It was 79 days in 2012. So that has deteriorated as well. We don't want to be paying our bills 79 days later on average because eventually our credit's going to be cut off. So to go from 68 days to 79 days is not a good thing. That has deteriorated, and that tells us that we're having trouble paying our bills. Okay, now, the next statement, the next item calls for the cash conversion cycle, which is basically how long does it take us to convert a sale into cash. So what we're doing is we're going back, we're taking our days inventory outstanding plus our days sales outstanding and subtract our days payable outstanding, which kind of measures how long it takes to convert inventory into cash, sort of. So we're taking the answers that we would have gotten in C, E, and F. So for 2012, we're going to take the 107 plus 58 minus 79, gives us a cash conversion cycle in days of 86 days. You would want to see this number be as small as possible. We want to convert our cash quickly. Okay, in 2011, we would have had 67 days. Okay, so in 2011, it took us 67 days on average to convert a sale into cash. In 2012, that's stretched out to 86 days. So this is pretty significant deterioration again, because we want to collect cash as quickly as possible. Okay. So when we're going through, and one of the questions, so question 2 asked us, did everything improve or deteriorate? Every single thing we looked at deteriorated. Note that we aren't going for the biggest number or the smallest number in every case. You have to look at each one. Like cash conversion cycle, you want the smallest number. Current ratio, on the other hand, you want the largest number. So you have to look at each one and know which one means it improved or declined. And then the third thing, where it asks what we need. Okay, you don't have to write this one down. I've just got all those ratios we just did listed here. This is nothing new on this sheet. I just want to refer to the third question. The third question is, as a manager of this company, what would you try to improve next year? So the best things that you could try to improve, inventory turnover. Inventory turnover, the more times you turn it over, the more sales you're going to have, or the more sales you have, the faster you can turn it over. And speed up cash collections, because cash collections, the longer we leave our receivables outstanding, the less our chance of collecting on them. So we would want to go after inventory turnover and receivables turnover. And that will provide us more cash to be able to use to pay our own bills faster. But we've got to work on, obviously, sales, getting sales up, but inventory turnover, can we sell faster? So look into that. So that's what we would try to improve next year. Now the next I have, so that does it on this exercise. The next item we have, I think, from what I was seeing, okay, here you go. For whatever reason, I don't have the question. I must have deleted it when I was fixing things. So a firm's ability to pay its current liabilities can be evaluated using working capital and the current ratio. That is true. We're going to do 2 more questions, and I'm going to talk a little bit about the final and some housekeeping details. Okay, so 2 more questions. Okay, the asset test ratio reflects the company's percentage of total assets financed with total debt. True or false? Okay, I have the answer false, and that is, okay, and this is false. You're absolutely right. The reason it's false is when we talk about asset test ratio, it only deals with current liabilities and some current assets. This question right here, percentage of total assets financed with total debt, that's actually the definition of the debt ratio. Okay, debt ratio deals with total debt, total assets. When we're dealing with the asset test ratio, that's some current assets divided by current liabilities. So this is false. Okay, a high inventory turnover may indicate that a company is experiencing difficulty selling its inventory. True or false? Okay, and I got a false. What do you have? 50-50. What do you think? Okay, so I'm up to 50-50. What do you think? False? 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 I have a bunch of falses now. Okay, and that is false. The reason is high inventory turnover means you're selling your inventory up many, many times. Inventory turnover is how many times a year you sell it, and the more times you turn over your inventory, that indicates that you are able to sell your inventory. If you have a lower inventory turnover, you're not selling it as rapidly. Okay, now what I'm going to do is I'm going to switch to talking about the final. And I will take questions about the final on Wednesday, but I did want to at least start talking about it. Okay, now, so starting with just we're going through some housekeeping. Okay, through this weekend we have the Chapter 13 homework and Chapter 13 homework attendance quiz from class today and Wednesday. So that's the same. Saturday is the end of homework for this class. Then the final exam review sheet, it's on Blackboard already. It's under exam info. And the URL is there if you prefer to grab it there. There is a 10-point bonus opportunity on the final. I alluded to this last week, last time we were in class. If you take the final exam Sunday, December 8th, you could take it between 8 a.m. and 4 p.m., finish by 6 p.m. So you have to start it by 4 p.m. You have to submit it by 6 p.m. By 6 p.m. it's Eastern time. It also means you have to submit it by 6 p.m. Submitting it at 6:01, you're out. So don't run up against the deadline. So there are no exceptions. That said, we have a handful of students registered with Student Accessibility Services. Those students can contact me. This 10-point bonus opportunity applies whether you are in sections 1 and 2 and taking it in the computer lab, or in section 7 and 8 and taking it with ProctorU. Doesn't matter. This bonus point opportunity applies either way. We don't do points on this. It adds 10 to it. So if you got 100% on the final, you would get 110. Okay. Yes. Yeah. 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 I have structured this around the computer lab hour. So yes. So yes. And Brian and I will be the proctors, some of the proctors on Sunday. So yeah, so we know they're open. So they are opening at 8 a.m. and they are closing at 6 p.m. But to qualify for the 10-point bonus opportunity, you have to start your exam by 4 p.m. You have to submit it by 6 p.m. If it gets submitted at 6:01 p.m., you're out of luck. That is, the cutoff is 6 p.m. period, Eastern time. And it doesn't matter if you're taking it at ProctorU or in the lab, you will still get it. Your bonus will not show when you submit your exam. This is something I have to add in later. So when you finish your exam, that 10 points doesn't show. I will email but you will recognize when it's been applied. There'll be a little asterisk next to your score, and your score will be 10 higher than what it was. Okay. Then just looking ahead, I'm getting a lot of questions about this. Your 1 lowest homework score and your 2 lowest quiz scores are dropped by Monday, December 9th. I can't drop them ahead of time. I have to wait for everything to be in, and then those will be dropped. If you came and saw me earlier in the semester about the get out of jail opportunity, today is the last day to visit me to get an assignment opened up if you've not done that yet. I will enter course grades in Flashline. I'm not, and I'll talk about this Wednesday more, I'm not going to adjust one person's grade because there's 500 people. So if someone says to me, oh, I really deserve a higher grade, can you bump me up? That's not fair to everyone else at that same grade level. So if I adjust any one person's grade, everyone's grade gets adjusted. So there's no way you'll lose out because you didn't ask or anything. I'm not adjusting individual grades, and I cannot discuss individual grades until I get all the grades done. Yes?
You said you're going to drop the lowest score regardless if we came to you or not.
Okay, let's go back. In this class, there is a policy that everyone gets 1 homework score dropped and 2 quiz scores dropped. That's applied across the board to everyone. If someone came to visit me, they get a do-over. It's not a drop. Okay, and that's separate, but you would have to have visited me earlier in the semester and then no later than today see me. And today I'm in my office from 9:15 to 10:45 about. I have a meeting with the dean at 11. That's why I have to leave a little bit early. And then I'll be back in my office from 1 to 2 today. So you have to see. Yeah, any quizzes. It doesn't matter. Okay, so when we're dropping the 1 lowest homework score and the 2 lowest quiz scores, any quiz, period. Okay, they're all the same to me. They are all weighted the same. I can't distinguish between them, so it'll just be 2. Once I do that, I will email you out, and you will be able to verify that. And when you look at your grades and you have 2 quiz scores showing, you know, for when you take it twice, only your highest one ever counts in your grade. Okay, they're just both listed there for you. Okay. Okay, now that's what I had for today. You can stop recording, but what we're going to do now is if you're in here, we have evaluation.